Okay, let's dive right into this explainer and unpack the massive AI build-out we're seeing from companies like Meta and Alphabet. If you just glance at the headlines or look at their top-line revenue, these hyperscalers look like absolute unstoppable money-printing machines, right? They're funneling billions into AI infrastructure and projecting this immense confidence. It's incredibly easy to look at the current bull market and just assume the financial foundations of this whole AI revolution are completely bulletproof. But as we're about to see, when you peel back the layers of their accounting, a very different and honestly much more complex reality starts to emerge.
Because when accounting experts like Kevin Kaharki and John Well actually dig into the financials of these hyperscalers, they describe the jaw-dropping earnings we're all seeing as an optical illusion. Think about that. That's a really heavy phrase to use when we're talking about some of the most valuable companies on the entire planet. Well, a veteran financial journalist and Kaharki, a seasoned analyst, noticed this glaring gap between the reported profits and the actual cash remaining in these businesses. Basically, they realized the standard numbers being broadcast to the public are masking the true monumental cost of competing in this AI arms race.
And this brings us to a massive discrepancy that we really need to investigate. Think about it. If these companies are generating record-breaking cash flow, why on earth are they suddenly taking on huge amounts of debt? Historically, big tech companies have been pretty asset-light. Aside from maybe Amazon, they haven't needed to leverage their balance sheets heavily with debt because their legacy businesses just threw off so much cash. But suddenly, we're seeing this massive shift. They're out there borrowing billions. So we gotta ask, what is silently draining their coffers behind the scenes?
Well, to understand this illusion, we first need to look at free cash flow. The traditional calculation is honestly remarkably straightforward. You simply take the cash from operations and subtract capital expenditures, or Capex, which, by the way, includes all the money they're spending on those massive new AI data centers. Whatever cash is left over at the end, that's your free cash flow. It's the lifeblood of any mature company. It's the actual money available to pay down debt, issue dividends, or buy back stock. Really, it's the ultimate measure of a company's financial health.
So the crucial point here is applying the Warren Buffett owner's mindset. Imagine if we pooled all our money together and took Meta private today. How much of that reported free cash flow would actually end up in our pockets at the end of the year? Buffett always argues that you shouldn't just look at the accounting metrics. You have to look at the true cost of running the business. If you own the whole pie, any mandatory expense that leaves the company is a reduction of your actual cash profit. And when we apply this rigorous standard to these AI giants, well, their mountain of cash starts to look a whole lot more like a molehill.
To figure out where that cash is actually going, we have to look at the incredibly fierce talent war for AI engineers. These folks are commanding massive pay packages, and those packages are largely funded through stock-based compensation. Because building AI isn't just about buying servers, right? You need top-tier talent to design the models. And these engineers literally have their pick of employers: OpenAI, Anthropic, Meta, Google, you name it. To win them over, big tech hands out vast amounts of restricted stock units and stock options. Now, on the surface, this looks like a sweet deal for the company, since they don't have to pay out actual cash salaries up front. But as we're about to see, the bill always comes due.
This fierce talent war triggers what we call the dilution loop. Let's walk through it. Step 1. You issue stock to your new AI engineers. Step 2. That stock vests, and naturally the engineers sell it to get their cash. But here is the major problem. Step 3. If a company just keeps creating new shares out of thin air, it dilutes the ownership of regular investors. To prevent a massive shareholder revolt, the company uses its own cash to buy back stock on the open market, which leads to step 4. Actual cash leaves the business. At companies like Meta, up to 90% of their stock buybacks are used purely to offset the new shares created for employees. Let that sink in. That means real cash is quietly leaving the business, operating exactly like a regular cash salary expense, but it's completely hidden away in a different part of the financial statements.
To put the sheer magnitude of this hype into perspective, Meta's projected reported free cash flow for 2025 is a staggering $46 billion. Now, if you're an average investor looking at that figure, you're probably thinking, wow, this company is invincible. With $46 billion, they can easily afford to build out endless data centers and fund absolutely all of their AI ambitions without breaking a sweat. It's exactly this kind of surface-level number that fuels the incredible market valuations we're seeing today.
But wait,
When we actually adjust for the true cash costs of that stock-based compensation, plus the related withholding taxes, Meta's actual free cash flow completely plummets. It drops to just $5 billion. Seriously, take a second with that. By applying the Warren Buffett test and treating stock-based compensation as the very real cash expense it ultimately becomes, $41 billion of that assumed cash simply vanishes. Poof, it's eaten up by the absolute necessity of paying the engineers who are actually building the AI. Now look, $5 billion is still a lot of money, obviously, but it completely changes the math on how easily they can finance the future.
And this brilliantly illustrates that this isn't just a Meta problem, it's a sector-wide issue. Alphabet also takes a massive 67% hit when we subtract the hidden operating cost of paying their AI talent. Their reported $73 billion drops down to an adjusted $24 billion. Meta, like we said, takes an 89% drop. We are literally talking about tens of billions of dollars disappearing from the bottom line across the board here. This isn't just one rogue company being aggressive with their accounting. This is the fundamental structural reality of the modern AI economy.
Now you might be wondering, how is this even allowed? Well, it all comes down to standard FASB accounting rules. The Financial Accounting Standards Board isn't doing anything illegal here at all. They are just strictly following what's called the matching principle. They conservatively expense stock based on its value on the exact day it was granted. But they completely ignore the massive future cash cost that's required to buy back that stock when it vests years later at a much, much higher price. Essentially, the accounting rules just leave it up to informed investors, what FASB officially calls knowledgeable users, to spot the difference and do the real math themselves.
Because so much cash is secretly tied up in this employee compensation, these historically asset-light companies are hitting a very real wall and having to turn to their balance sheets to fund their AI dreams. Take a look at Alphabet's capital activity in just the first quarter of this year. They issued $85 billion in shares and borrowed $30 billion. Think about it. If their adjusted free cash flow was truly massive, they absolutely wouldn't need to issue that kind of debt. They're leveraging themselves in this frantic land rush to build infrastructure, simply because the cash generated from their legacy businesses isn't enough to cover both skyrocketing engineer salaries and skyrocketing data center costs at the same time.
Yet, despite this massive cash drain, Wall Street analysts are out there projecting this miraculous checkmark-shaped recovery. Basically, analysts currently predict that free cash flow for these hyperscalers is going to briefly collapse due to all these heavy investments right now, and then just wildly double by 2029. It forms this perfect, optimistic checkmark on a chart. But this incredibly rosy projection assumes that the heavy spending phase just stops. It assumes they build all the data centers, write all the code, and then just sit back on a beach and print cash with vastly improved unit economics.
However, NVIDIA's CFO recently threw a massive wrench into that whole checkmark theory. They predicted that data center infrastructure spending will actually need to hit $3 to $4 trillion per year by 2030. To really understand how staggering that number is, consider that the total global IT spend right now for literally everything across the world is only about $6 trillion. So to suggest that AI infrastructure alone is going to require up to $4 trillion annually, that means the massive capital expenditures we're seeing today aren't just a temporary spike. They might actually be the new permanent baseline. The spending might literally never taper off the way Wall Street is hoping.
And making matters even worse, engineers are actively warning that the extreme energy and water demands of these AI data centers will likely cut their life cycles right in half. Traditionally, when a company builds a legacy corporate building, it lasts a good 30 to 40 years before needing any massive reinvestment. But these new AI data centers, they run so incredibly hot and require such extreme power and cooling that they degrade rapidly. Engineers estimate they might only last about 15 years. This radically accelerates the next totally expensive wave of Capex. You practically haven't even finished paying off the first data center before you have to turn around and completely rebuild it. This is a massive hidden life cycle cost that is barely even being factored into those optimistic Wall Street models.
So, with these unquantifiable future environmental costs looming, life cycle replacements dramatically accelerating, and true cash flow significantly lower than reported thanks to that hidden stock-based compensation, we really have to ask the ultimate question. What happens if the bull market just stops giving big tech a free pass to borrow against our hopes and dreams? Right now, sure, the market is totally willing to put high multiples on breakthrough technology, happily tolerating the dilution and the debt. But if the timeline stretches out or the costs climb even higher than projected, can these giants actually land the AI ship and figure out monetization before the illusion of their infinite cash flow finally shatters? It's a fascinating, precarious high-wire act, and it's one you absolutely need to keep your eye on.